Right, let's move on to our first panel session for this afternoon. And it really, I think it runs very neatly off a lot of what we heard this morning. Some positivity and some frustration in the course of the morning. The session is entitled Unlocking Capital for Europe's Raw Materials Future and Closing the Gap. That is the challenge. And ladies and gentlemen, first thing I'd like to do is invite all our panelists to come up on the stage, please. Come on up. Round of applause for our panelists. So on the stage we have Olav Skalmeraas, who's the CEO of Norge Mineral, Dr. Frank Jackel, who's the CEO of Metalshub. We have Peter Verbaken, head of liquid commodities at APG, and we have Yann, who's the managing director at Deutsche Bank. And I'm delighted to say we are joined all the way from Brisbane, also by Bert Koth. Bert is there in the screen. Bert, we've got you. You're shining brightly up on the top of the auditorium here. Bert is partner with Denham Capital, and thank you very much indeed. Bit later in the day for you than it is for us, but very good to have you here. So let's get the ball rolling here. We have those in the mining and extraction business who are itching to get on and make a difference within Europe. And we've got a very good example of that for you in a moment. And they have their own challenges about making that happen. So, Olav, I'm going to start with you because here you are, a massive opportunity. Norge Mineral involved in phosphates, vanadium, titanium. You've got a renewable power source to draw on in Norway. You've got a government that's interested in fast-tracking assistance as well. You better tell us what you need.
Yes. So to complement what you said on the list of our portfolio, we are in the process of acquiring the biggest graphite mine in Europe. So we are also in the phase of production and supplying strategic raw materials. Yes, we have seen an unprecedented race for CRMs. And I would, what does it take? So I would rephrase a very famous saying for 30 years ago. It was the advisor of Bill Clinton, and it's financing stupid. It is financing, which everything is relying on. Yes, BHP, Rios, LKAB, they have balance sheet. We don't have balance sheet. We are a junior company. We need to earn our right to finance. That's the challenge we are in order to get to the finish line. But we are one. I think we need two more into this party, and that is the authorities, and it's the finance community. And we need to collaborate as a three-party. Otherwise, we will have regulations which don't fit. We will have a finance market which has an old perception of the mining industry still. And we have a mining industry which is doing the utmost to actually deliver a sustainable and secure mine, but we don't have finance. And especially this case is in the early phase. When we come to a final investment decision, then we have a more structured project, we have the financing plan and the economics more firm. But in the early phase, which is very important now to get minerals to the market in 2030 or 35, we need to have more risk capital. That brings me to the role of authorities. What role do the authorities have? Yes, they have done a lot with the CRMA. We have seen countries which has done even more, establishing CRM funds. It's great. They are very accommodating to our discussions. But what do we need more? We need to get rid of the uncertainties in permitting. That's a critical risk for us and the finance community. We need a real streamlined, efficient, one-stop shop process. And then on the public funding instruments, mining and processing seems to fall in between. We have the Horizon funds, which is more R&D and all that. And then we have investment fund, which is more manufacturing. So it seems that mining and processing doesn't fit with the instruments in the EU. But more importantly, the role of the authorities, I believe, and I do think Frank will come more to it, it's to facilitate the transition into a more transparent markets, where we have price discoveries, which makes much less risk for investors to invest in mining and processing. And the toolbox I leave to Frank to come to. I'm sure he has the answer. But we need a level playing field. We are going to deliver carbon neutral materials, critical materials. Do we get more paid for it? No. Then we need the authorities to create a level playing field that we are getting credit for our efforts in delivering sustainable carbon neutral materials. Then to my last point, and that's to the financing community. Do you know more than 80% of European funds do not invest in mining? And it's even worse. Some banks, they don't want to have bank accounts for companies who are in mining. So the mining industry are really stuck. So firstly, I think the finance community needs to wake up to 2025. The mining industry is not what it was 50 years ago, 30 years ago. It's quite different. The finance community need to build competence and insight in mining and processing in order to assess risks and opportunities. Right.
Okay. So I'm going to hold you there, Olav, for a moment. So there's a lack of insight coming from some quarters, perhaps. The man sitting to your left, I'm going to come to Peter in a moment. He's sitting on some 600 billion of assets under management in a pension fund. So there's a lot of money available. There's a lot of money out there, and we'll have a chat about perhaps some of the reasons why it's not always as accessible as Olav certainly would like it to be. But before we do that, Bert, I'm going to turn to you. First of all, a simple question. Are you hearing us okay? Excellent. That's a good start. In which case, would you like to respond as someone who is both in mining and in capital? Would you like to respond to some of what you've heard from Olav there?
Yes, absolutely. I mean, to answer the question why there's not more money available, I think, there's many reasons, right? But let's just discuss three reasons. Well, before we do that, I think it's important for everybody to understand that we actually have a real dichotomy here in that we have an unprecedentedly high demand for mining investment, and at the same time, potentially the largest ever contraction in risk capital in metals and mining. So this is actually a point in time where market forces and strategic critical mineral objectives are actually absolutely not aligned. Now, a fulsome discussion why there's not more risk capital in mining would take probably several days. Well, we don't have that. So I shall just focus on those three reasons that I encounter myself and the rest of my firm all the time. So one is something that we can't do anything about, and these are the elevated interest rates. So typically, the higher the interest rates are, the more the risk capital pool in general gets reduced. So there's nothing that at least all of us here in the conference can actually do about that, because what it means is that fewer projects are getting financed, and those that are getting financed have a higher demand for higher equity returns. So, but on the other two are partially under our control. So one is the technical execution risk of mining projects, right? So typically, the last few years, exacerbated by the cost inflation, a lot of mining projects have 40, 70, 80% capital overruns. The risk is unfortunately even more pronounced in those critical mineral projects like rare earth, lithium, etc. So you have actually higher capital overrun risks in those. Many projects fail outright, and only a small percentage of mining projects that have a feasibility draft that are actually in reality economically viable in real life. So now, I will address in a moment what can be done about the second point. The third point is what I would label misunderstood ESG and perception issues, right? As Olav has just said, the mining industry is not the same as it was 50 years ago. A properly managed mining project today brings only net positive to everyone, right? And projects that bring a net negative should never get implemented. So how can one mobilize risk capital for critical mineral projects against all these issues? Well, one is capital must be paired with experience. The best mining project is worth nothing if it's got the wrong management team, because they're not going to properly implement it and there's going to be capital overrun. So it is absolutely critical that capital is paired with management that actually has the necessary scars on their back and the necessary experience, because they know which mistakes to avoid. This is easier said than done, because the metals and mining industry suffers from a global skills shortage, like probably many other industries. The second one is what scares so many investors is this repeat history of capital overruns. The way the US has actually found an interesting way to address that in a project where we're actually involved with the US government. They actually provide several $100 million of capital overrun facilities at very, very generous terms for absolutely critical and strategic projects. So that's actually something that Europe should look at, because that actually takes to a significant degree the cost overrun risk for equity investors and project financiers off the table. And another aspect is really the one of downstream, because a lot of the critical mineral projects have very complicated downstream components that have higher than usual implementation risks and execution risks. For example, rare earth separation plants, extremely complicated. Again, we know what we're speaking about because we actually own and built over the last 14 years one of the world's largest heavy rare earth businesses, right? Hugely difficult business, right?
Okay. Bert, I'm just going to put a pause on you there, because I know you'll keep going, and we want some of those points to come back to us a little bit later. So I'm going to put you on a slight pause there. Can I just check, are you hearing Bert nice and clear? Hands up. Yes, great, excellent. So it's all getting out loud and clear, which is terrific. There are quite a lot of points brought there about some of the hurdles, and Olav, you might want to address those in a moment. But Peter, one of them was an ESG question. Here you are with pension funds I wouldn't say to burn, but to spend, to invest in, and ESG is clearly a big issue for you. Olav says actually it's a misperception these days. So just address that for us if you could.
Yeah, thanks, David. So, I mean, first of all, our organization very much recognizes the strategic importance of the raw materials. We make a lot of investments into renewable energy, and we cannot ignore the fact that there are a lot of raw materials going into that. So our CEO, Ronald Wijzer, he has dedicated raw materials as a strategic topic last year. We do believe there's a lot of gains to be made in sort of smarter use of materials and recycling and innovation. But in the end, more mining will need to be done. So why is there not more money flowing into it? I think it's I think it's twofold. I think, as Bert is mentioning, the investment risks are high. So if you look at sort of average cost overruns versus feasibility studies, they're very large. Exit routes are usually uncertain, and the timing is questionable. So these are factors that raise the risk from an investment perspective and make it a difficult match with a pension fund asset. As you mentioned, we are a pension fund asset manager. So that's a bit more conservative in those aspects. So it's a difficult match to make. And then that's the investment side of it, and then the reputational side of it might be even more important. So our client, it's the biggest pension fund in the Netherlands, has very high requirements in terms of ESG. And unfortunately, the sector is associated with elevated risks in health and safety and in environment. So that's, I think, a narrative that needs to change. And I think, so these elements, they apply more broadly in European institutions. High investment risk, high reputational risk, they're difficult to square and to actually get money flowing.
I mean, it sounds a little bit like you're saying, yeah, I sympathize, I understand your problems, but no can do.
I mean, so you have to understand, we are the asset manager, and our client is the asset owner, and the asset owner determines the investment mandate. Today, there's no investment mandate to invest in mining projects. So we need to convince them to actually do that. We cannot just say it's strategically important, put the money in. The investment proposition needs to be sufficiently attractive, and these ESG concerns need to be addressed. And I think it's that second part it's also about storytelling, about the narrative. As Bert was saying, the sector has come a long way in being able to produce more sustainably. That message needs to be more out there. Second, the clear benefits to the energy transition, to defense of the output of mining, that needs to be more out there. I think these are the things that need to sort of positively influence the narrative in this area that could help.
Okay, and Frank, let's move along the line there in terms of solution or potential solution. You know, the markets themselves can be very murky and difficult to judge. What is your view on how, at least one way, to make this a more viable proposition?
Yeah, I mean, we heard it already from Olav. He said, we need to create a level playing field, and there needs to be a transition into a more transparent market. Now, talking about market prices, that's always an interesting discussion that I have with our customers. They say, yeah, but the market price is that. And you can question actually whether the published market price is actually the market price. And we've seen numerous examples of where companies transacted at prices 10%, 15% above the reported spodumene, which is the hard rock material for lithium. They transacted above index. Now, if that's the case, you need to ask, why isn't there more market transparency, or what's the problem there? And what could be a potential fix for that? Actually, one solution was coming from the investment community. I think it was Resource Capital Fund. They have a blog post, and they said, build the market, not the mine. Now, what does build the market mean? If you don't have a liquid, fair, transparent spot market, and the price setting happens somewhere outside of your control, well, guess what? You will always be dependent on that market price. And I think there are three things that can be done. Number one, markets need to be created by creating liquidity in markets. If companies transact 99% of their volume on long-term offtakes and leave 1% for the spot market, or even 0% for the spot market, and then complain about the fact that we are so dependent on this price set in China, well, guess what? You're causing the problem yourself. So it's always easy to call for regulators, the EU, whatever, to change the system. First and foremost, it's the responsibility of the companies to allocate a certain volume to the spot market, to create liquidity there. Number two, you need to create transparency, meaning don't do backdoor deals. Keep it simple, transact on digital venues, use the tools that are out there today. The whole topic of price reporting, indexation worked well at times where everybody was truthful and telling the truth. Now those times are over. People are not always telling the truth when they're reporting prices. So you need some kind of digital venue where actually market prices are recorded. And if you combine those two, you get actually fair and transparent market prices in the markets where you work. And then third thing could be an option where you have market makers, be it large companies contributing, but also things like strategic stockpiling, where actually governments can also contribute to market liquidity and even create markets when prices are artificially low. They can buy volume. Yeah, and call out the crooks. We discussed that earlier. And also, if prices are inflated, they can actually ease the market.
And that's a government responsibility.
That's a government responsibility.
Least. Just coming back to what you said about companies and their responsibility in terms of liquidity and sort of buying into that transparency, how do you make that happen?
Well, first of all,
how do you create that momentum?
Yeah, first of all, they need to understand that this is a problem for them as well. There needs to be an understanding among the companies. But it is not only the sellers, it's also the buyers. So I've got a lot of sympathy, I guess, for junior mining companies out there that say, okay, we've been asked by the financing community to have more offtakes in place to secure our volume. Well, that's a demand from the financing industry. But also their customers, like big OEMs, they come around and say, oh, we want to have offtakes from you. I think everybody in this community needs to understand it doesn't work like that. Yes, we understand that there's a necessity for offtakes, but there needs to be a change of culture. You can't secure 100% of the volume. You need to have liquid and functioning, transparent markets.
I think, Yann, a little nod of the head there. You've listened very, very patiently to all of that. What does Deutsche Bank need for debt finance? What do you need to see come into play?
Well, before I touch into this, I would like to react to a couple of interventions here. I think I hear your critics about the lack of financing for the industry, and I think it's funded. Unfortunately, the risk appetite within the bank community is not very high. And that's a fact. And there are a few historical reasons for that. I mean, there have been heavy losses, and generally speaking, in the world of commodities, niche mining and minor metals have been at the top of the chart in terms of risk, given the volatility. And you touched on the lack of liquidity, the lack of transparency. So we need, as a bank community, and also obviously equity needs to play, to form a better risk appetite for this industry. And there is a lot to invest in expertise as well, so that there is a better understanding of the challenges. I'm quite optimistic, though. I think it's more a marathon, unfortunately, than a race, a short-term race, because you will need a lot of time for the bank industry to wake up to the call of more mining deposits to be developed and risk appetite to be formed. Now, in terms of ESG, for me, it's a big frustration because I'm a European, I'm a keen European. I have kids here, and I think it's not only mining and this industry in particular, but it seems to be extraordinarily difficult to build anything in Europe at the moment. Whatever you think about manufacturing plants, even wind farms are difficult to actually get permitting for. So the problem I have is that we lack of the full value chain understanding. So I will say something a bit caricatural, but a few banks maybe are present here will have some relief of funding and balance sheet enhancement to finance a battery plant. in Europe, but they won't have the same for the supply chain. So there is no point in incentivizing a battery plant construction in Europe if we don't secure the value chain and the supply chain, right? So somehow, and I agree with you, Olav, there needs to be an ecosystem where all stakeholders goes together and understand how we can help each other to make this risk appetite flourish. And that also comes for banks with some kind of balance sheet relief from a regulatory standpoint, but also better understanding as where the value chain is for defense, transition, and we cannot isolate one piece of the value chain and ignore all the rest. And I think that's the world we live in Europe at the moment. And I'm not saying I have an immediate solution, but we need to actually put the diagnostic where it is and work on it.
No, but we want you up here for a solution. That's what we want you for. Let me ask about perhaps a problem as well, which is related to what you're saying. You talk about the value chain, and the word is Northvolt. And I just wonder, as a banker, what impact something like that is having, though, across the piece in terms of, you talk about the need to de-risk and, find ways through. And I'll come back to Bert a minute also on, you need to couple with people who've made the mistakes. But what impact has that had?
Fortunately, my team did not manage that specific transaction.
Which is why I asked you.
But it's crucifying to see that we are not able in Europe to actually develop a conventional battery industry because of all the problems we've discussed. But the impact is, for me, is more it's a bad in a good, because it reveals that we need to do much more than just go ahead and build a battery plant. We need, again, to think about the full value chain and how we create that ecosystem that works for Europe, right? And we have few missing pieces that we need to work on. My job in the bank is to develop the risk appetite and finance upstream commodities project, not only in metals and mining, but also oil and gas, which is another sort of like long sort of discussion we may have about how we handle this fossil fuel approach in Europe, because we're a big net importer as well. But we need to come to the realization that ESG is very important, but building and maintaining a flourishing industry requires to actually think about these sort of things. ESG cannot be the sole driver of how we manage the economy in Europe.
And when you say we, who is the we? Who is the we you've got to convince there?
Well, I'm being part of the ecosystem, so I say we, but we're all responsible for improving the way we think. And there is a mindset shift, right? But in actual terms, you ask what Deutsche Bank wants to do, and we're here today, right? So we are really willing to make a positive contribution from a financing standpoint. We see a lot of our clients and prospects struggling with equity. That's a clear thing. We are bankers. We have thin margins. However, you may complain about the interest rates and margins, but we make very thin margins. So if we make a big loss on one small project, for us it's franchise destroying, right? So we need to be careful, being very selective. And fortunately, we are a bank. We want to finance profitable projects. We want to manage our risks. We need to go after low cost curve projects. And, there will be disappointment in the mining industry because we, the bank community, will actually be very selective because we have to. And that's a challenge that, I have to actually display on this stage, right? It's
Thank you. I'm not trying to hold your feet to the fire, particularly. I'm just interested. Bert, you've been listening also into this. I wonder what you make of it. As something of an outsider, I can look at mining companies' annual results and see these billions and billions in profits. It seems like there's good money in mining.
Well, we've been financing and building those things for over 20 years, right? There is good money in it once you get it up and running, right, successfully, and once you actually have a low-cost project, as just mentioned, right? Look, it's really all about getting the risk profile down, right, to regain confidence, and that's easier said than done. But it really boils down to three things. One is avoid difficult and complicated projects, right? That sounds like kind of self-explanatory, but it's not, because a lot of the critical mineral projects are actually extremely complicated, like lithium hydroxide plants, graphite anode plants, rare separation plants. This is all seriously complicated stuff. So, but as much as possible, avoid complicated projects. Number two, realistic assumptions, right? As somebody who is financing those projects, we have hundreds of junior mining companies coming to us, right? And like 95% of projects, frankly speaking, that are being presented to us are being based on unrealistic and optimistic assumptions. From how much it's going to cost to build them, from the time it's going to take to commission them, very often from the underlying price assumptions. So they have to be realistic assumptions that reflect realism and not optimism, right? Optimists die in this business, realists survive. And number three, as I've mentioned before, you got to pair capital with real experience. Real experience is different from having good intentions. There's lots of well-intended people out there who are enthusiastic, but capital has to be paired with management teams who have done this before. And ideally, not having only done it once, but 3 or 4 times before, right? Who have the scars on the back, right? Who have learned from their mistakes and who are out of their personal experience sensitized to avoiding mistakes. So, and that all sounds completely obvious, right? But it's actually very, very, very difficult to achieve. And it's actually very difficult to achieve against the backdrop that the world, not just Europe, not just European supply chains, but the world needs an unprecedented high amount of metals and mining investment, right? Declining grades globally. Everybody wants to secure the supply chains, not just Europe. Energy transition, defense need more metals and minerals. The easy stuff is already mined out, right? The large, easy projects that are high grade in safe countries, those fruits have been picked from the tree. Yeah, the future are really high quality projects, typically in more difficult countries, right? Or more complex projects in safe countries. That is the future, right? And against this backdrop, one just has to try to very ruthlessly and with a lot of discipline apply those 3 principles. Avoid any unnecessary layer of complexity, realistic assumptions, and capital should only back experience.
Okay, 3 very clear points there. I wonder if you'd like to pick up on those 3 points made and how that might impact you.
Of course, yes, deposits are getting more complicated, and some deposits are even more complicated than others. So what we have done, we have won from our ore. We get phosphate, we get vanadium and titanium from the same ore. It doesn't sound as complicated, but to really do this in an efficient way, cost-efficient and trustful way, we set down, when we started the project, to have the best technical team that is in Norway. That's my subjective. So that was a way to mitigate the technology challenges of a more complicated deposit than normal. And then, of course, realistic assumption, yes, we all need to be on that. And then I will go back to ESG. No capital will flow into a project which is out of tune with the society it shall operate in. So that's the baseline. So we are not discussing that. We need to be in tune with the requirements from the society, local stakeholders, regional stakeholders, national stakeholders, whatever regulations we see coming. So we are not talking about making an ESG project anymore. That's the baseline. We need to do that. We are not getting funding if we are not there. As you said, the reputation from an investor is very important. Yeah.
But then if that is the case then, Peter, isn't the argument is fairly simple. We are ESG. This is us. This is what we do. Why is that message not taken seriously.
Yeah, I think that
there's no other part of the world that does it as well. You could argue that.
Yeah, so I think an earlier panel member talked about BIMBY instead of NIMBY, so better in my backyard instead of not in my backyard. I mean, I agree with that, right? We need to acknowledge that these materials are required for us. The energy transition will grind to a halt if we don't do this. Defense spending needs to be ramped up, so these are required. And the fact is, are you buying it from regimes that you don't agree with, or are you trying to develop them yourselves? I think again the problem is it's twofold. It's the investment risk, where we need to find ways to, let's say, de-risk them. You can think about maybe cost overrun facilities or strategic stockpiling projects that guarantee some of the offtake. We need to think of all of the above, basically, right? All of these things need to happen to try to de-risk these projects. And then on the ESG side, it's really telling this story. I recognize that, you know, the mining sector has developed, and these ESG issues are, you can't fully avoid any issue, right? So, but the sector has come a long way. And I think the other side of it, positive impact on the energy transition, needs to be much more on display to convince these asset owners. But I mean, like our biggest client and majority shareholder, it's the biggest Dutch pension fund. They are very much in the public eye, scrutinized by the media. So any issue with one of the mining projects that you would invest in it provides a problem with them, and they're very averse to that. So there's not a quick fix. There's not one way to address that.
Olav, as you know, the European Commission has announced 47 strategic projects all across Europe, more to come with non-EU partners as well. How encouraging are those when you look at the sort of areas that you feel there needs to be improvement on, so whether that's permitting or other aspects?
I think to get the label a strategic project will help, but it's no funding that comes along with that. But as we have heard Nicola Bert from EIB, she says that if you have that classification, you are in a fast line of their assessment. So of course it helps to get such a label.
Okay, thank you very much. I'm going to open this up to questions from you as well. So if I could just see any show of hands for anyone who's got a thought they'd really like to put out to the panel. And we have one actually straight down in the front there. Is there a roving mic around somewhere? As we find the mic and bring it down to the lady near the front here. Just one other thought then. We had from Bert mentioned other countries' approaches and other parts of the world, and reflected on US overrun facility, for example. Are there any thoughts, I mean, Frank, I'll start with you, of other approaches from elsewhere that could be brought into the field here that would help?
I mean, the concept of, for instance, strategic stockpiling isn't new, by the way, in the market. So the US is doing that, Korea is doing that, Japan is doing that. There were also a couple of European countries doing this. I think this is something that works for them. It creates markets. The Chinese have been very smart in the way they operated. They understood that actually in order to make certain projects viable for them, they need to control the pricing and they need to control the market. So it's not a surprise that actually for rare earths, where is the major price index based? CIF China. Lithium, CIF China. And you can go on and on forever. I think this is something where European regulators, companies need to think about how do we get actually pricing power, transparency back to where we produce and where we actually need the material.
It's that issue of transparency again, very much to the fore. Okay, thank you. Yeah, we've got some hands beginning to emerge. First of all, thank you.
So my name is Karin Tinelius. I'm from Sibanye-Stillwater. I have a question of governance, because when you're talking that there is a lack of transparency, that assumptions are not realistic, that they're optimistic, what are the boards doing? Normally, a company has a board. There could be independent directors. They actually have a fiducial duty to make sure that all these issues are addressed. So is there a problem with the governance and board structures in Europe that makes that you don't feel the trust for investments?
A company like Sibanye is a very mature, established mining company, right? But financiers are typically approached by junior mining companies who are desperate to get the funding, and many of them will do anything to get that funding. So literally, when you go through price assumptions, safety cushions for capital overruns, I say the vast majority of junior mining companies present unrealistic investment cases. And yes, so there is a governance issue embedded in that.
Thank you very much. Thanks, Bert. The governance issue, any of you on the stage? No, you'd like?
Well,
Olav?
I'm very much scrutinized every board meeting on this. So, yeah, I don't see the issue, at least from my point of view.
Okay, thank you. Just as we move the mic there, I'm going to come to you in just a second, but I've got a question here also, which I think we can put up on the big screen. This is from David Burrows. Should junior miners flip their projects on their heads? So instead of mine, then processing plant, finance the plant first, which is a lower risk, and then sell the mine as lowering the risk of the plant by guaranteeing supply. Interesting. A thought.
Well, it's not only a thought. We are working on this path, except we are not planning to sell the mine. we are planning to integrate downstream from phosphate concentrate in the mine to elementary phosphorus production in the market.
Right, and that feels more plausible, more...
Because, yes, value added. Secondly, lowering the risk of the total value chain. And then you have a wider market to play on.
Okay, thank you. Yeah, okay. Yes, sir, thank you.
Hi, I work for a policy think tank in India. We work very closely with the Ministry of Mines there. One of the, of course, finance is a very important challenge, but unlike many other sectors which government is prioritizing to scale up, there's always a quantitative estimation on what is the money that is required until a particular year. This may be net zero, this may be 2070, 50, and different years. For mining, this has been a very difficult estimation. Every site is so different, every mineral requires a different set of expectation, and without a clear number, a clear target, it's very difficult to mobilize all the policies in a particular direction, specifically both for financiers but also for banks. I don't know, is there a better way on how can we quantify the demand of finance by a particular year so that people can start at least collating or coordinating better in terms of what is the money that will be required?
Okay, it would help to focus the minds to know what that horrendously huge figure might be,
yes,
essentially.
Yes.
Yeah. Any thoughts, Jens? Bert?
I think we're talking minimum of hundreds of billions of US dollars in the next 15 years.
Okay. Any other thoughts on the panel? Okay. There's a huff from Frank. Is there a thought to go with it?
Like crystal ball reading, I mean, there are lots of consultants that are doing projects trying to estimate what's the future demand and the supply balance, and I've done those things myself, and it's always like you start taking so many assumptions into account that the result in the end is just a matter of what kind of assumptions you take. So I think that's always a bit of
and is the number so big that perhaps it doesn't really stack up? I mean, we had Paul Gape from Anglo American earlier repeating that figure. We need 10 new mines, 15 new processing plants, 15 new recycling plants by 2030. You know, these are such vast sums and vast projects that it's perhaps unrealistic to think that they can be turned into a ballpark figure. Yann?
There's a lot of research. I think, no doubt in my mind that transition and defense will need much more material across the board, right? So, but you know, from a banking perspective, if I look at the new lithium mine, I have to assume much higher price in my modeling than the current price of lithium. So I lose the sense of humor of my credit teams very quickly, right? So these are not easy things to solve, because basing your views on research has some limitations, right? You also look at what's happening currently on the market, and when you need approval from a variety of stakeholders, they will obviously shy away from any sort of, I would say, aggressive assumptions in your modeling, especially as in a bank model, you want to show that you are conservative enough according to current market expectations. And making a pie in the sky expectation for the next 20 years, it's always like a peculiar thing to do.
Thank you very much indeed. We have a gentleman in the corner there, thank you. If we get the mic over there, thank you.
Thanks, interesting discussion. Colin Rice from Aspiring Materials in New Zealand. I've literally just got off the plane this morning from Washington, and while the US is turning more, shall we say, internally focused, it's interesting to see that they've turned their Exim Bank, which was a policy banks focused on export, and are now given that a mandate to encourage integrated supply chain from offshore, so long as the critical minerals are ending up in the US. From the discussion, it sounds like funding's already pretty hard within the EU. Is there any scope for that wider horizon and helping to attract minerals flow into the EU?
Thank you. Any thoughts there? It's too good a question. Yeah. It's too good a question. Yann?
I don't have anything smart to say on this one, so I think it's part of the marathon I was mentioning earlier. You know, any initiatives could help form a risk appetite and the ecosystem to put itself together. I think what should drive us, and so it's a bit away from this question, and drive us as a continent is economic development and people being happy living in a continent that can do projects. And I want to be a bit disruptive here, but I like vanity projects. So putting aside for ESG, I remember, if you look at history, Europe used to be the place where all the vanity projects happens, the Eiffel Tower, the Universal Expositions, etc. Taking risks without regard for economic consequences, etc. So this era is gone. You need to go to Dubai or Shanghai or these kind of places that is heavily criticized by Europeans, by the way. Maybe Europe has forgotten where we come from. We used to be on top of this game, and we struggle to, again, I repeat myself, to build anything new, right? So I think that's food for thought. And it kind of, we can incentivize and say we need more critical minerals, but we need to have the ambition to actually grow our economy and industries again. That's the roots thing, right? So it's away from your questions, but everything needs to be considered to secure the supply of critical minerals, critical materials, in the same way China did. It was a long-term planning. Europe used to be a place where there was long-term planning of big industrial projects, trains, aerospace, energy. When I see Europe now, the blackout in Spain, it seems that we have a lot of fashionable things that we push hard, but without thinking holistically, what do we need as a continent for industrial development? And so...
Can I make a quick comment here? So I think the real question is, what is it that Europe should be doing, right? And I think part of the answer is, frankly speaking, to make a bit of a copy and paste from the playbook of China, Japan, and the US, right? So, for example, Japan has an agency that's called JOGMEC, right? That partners with private sector exploration companies to have a foothold early on in very large critical minerals projects, right? That is something that can be done. The Japanese have been doing that very successfully for decades. The US government, for example, has recognized that cost overruns are a major investment vehicle. So there are projects where the US government provides some very intelligently structured cost overrun facilities that take that risk off the table for the equity as well as for the conventional project finance, right? Chinese companies very often partner with entrepreneurial teams who understand a particular country, right? And they cut an economic deal with the team. Look, you find on secures that project that delivers us X whatever of that metal, and you get X% of the economics and we get the offtake and Y%. So there are just so many things that can be done, right? But it does require outside the box thinking. What would be a great mistake is to throw a lot of taxpayers' money at projects that in reality are not viable, right? I also see that happen in a number of jurisdictions because that means a taxpayers' money is wasted and it means it anyway doesn't secure the critical minerals when the projects don't happen ultimately, right? But there's a lot of ways how to do the things very smartly. Again, I repeat, for example, to pair money with experience, right? So, for example, European pension funds could back funds, entrepreneurial groups, or companies with significant capital to secure and develop critical mineral projects in exchange for offtake. Off-takers who need these materials could partner with entrepreneurial groups who have this cars on the back have done that before, right? To pursue and to develop those projects. Now, having said this, most off-takers should not become mining companies themselves. That probably would be a recipe for disaster, right? But I'm saying there's just so many things that actually can be done that in Europe one doesn't see being done.
Okay, Bert, thank you very much indeed for that. Do we have any more questions? One last hand up coming? No? Fine. Okay, in which case, I just want to put this to you, Olav. No more generous offtake requests. Get these markets to be more transparent. Create an environment which actually would encourage more investment. I think that's very much the message Frank is sending your direction. Can you see that coming?
Yes, but we need facilitation from the authorities. Without, we will not be able to. It's like being in an orchestra. Half of it is prepared to play classic, and the other half of it is prepared to play a modern music. That would be catastrophic if there was no conductor. We need the conductor to get started. Then I see we are on a good track to create transparency, offtake, and create trust among the finance community.
More alignment, more harmony. I think it's one of the EIT RawMaterials sort of essences is to drive that sort of coalescence.
Yes.
Peter, on ESG, sorry to come back to it one last time, but we've talked about we have to change that perception. Will it come? Can you see how it can come? Because this perception question, it dogs everybody everywhere, and yet here in Europe, it is a strong. We have a strong case.
I think there is a good case. I think but there's no quick fix. So to change this narrative, to change this perception, we need every element of the sector to play a role, and also governments to play a role. So I think that's just what needs to change on the ESG side. We need to tell the story that mining is by definition better done within the European jurisdiction, that the sector has come a long way in addressing sustainability issues, and that the output that we're discussing actually has huge benefits for society and for the energy transition. So that story needs to be out there.
Another part of that orchestra, I suppose, one more instrument in the orchestra. Frank, a last thought?
Well, I think the EU should continue to be the beacon of free trade. And this is what the free market economy was about, and not trying to over-regulate it, on the other hand. What the EU shouldn't do is actually try to be all of a sudden participant in the market in the way that they provide a platform, etc. And they don't need to reinvent the wheel.
Isn't that one of the problems? Free trade doesn't necessarily work anymore. There is a certain part of the world that will bypass free trade.
That's true. But then you need to actually create the market for free trade where actually companies can do this. And that will attract investment as well.
Okay. Yann, last thought.
I think it's a very good point. And I agree with regulators and authority helping to shape the ecosystem, and including on the financing side, maybe more for banking than funds. But we need to have a positive sign from the regulator about how we use a balance sheet. If this is so critical for Europe, then there should be also some regulatory incentive for banks to actually release the balance sheet for the sector. I have to be honest, though, on ESG, the limiting factor for banks, at least for Deutsche Bank, is not so much ESG and mining, although if we could classify certain mining financing as sustainable finance along the value chain, that will help. It's more the risk, the actual risk and profiles of the projects we see, and forming the view. But the authorities could help. We have CR3 in banking. Maybe you're not too familiar with this, but there is no necessarily any incentive to actually focus on these kind of projects. And so if they are so crucial for Europe, then the entire ecosystem of regulatory system should actually act together in helping the banking community to channel more capital to the industry.
Okay, well, I hope in the course of this hour we've managed not just to address the many challenges, but to look at some potential solutions. It feels to me as if there are solutions out there. The message is they don't happen overnight. The problem is it's urgent. And that is perhaps a dilemma that everyone has to face, not just now, but in the weeks and years ahead. Ladies and gentlemen, after an absorbing session, please thank our panel for their efforts. Many thanks indeed.